Good afternoon, ladies and gentlemen, and welcome to today's webinar titled Navigating the Sector-Agnostic ESRS. This webinar is meant to provide a view on sustainability reporting amongst listed real estate companies in Europe and the UK. The webinar is brought to you by EPRA in collaboration with JLL, and we'll be covering a brief introduction on the EPRA sBPRs, the objectives, and the reporting landscape. We'll then move on to the scope and methodology of the report, which you can download via the QR code you can see on screen. We will then go into the detailed analysis of the results and capping off the presentation by a Q&A session and closing remarks. So my name is Hassan Sabir. I'm the Finance and ESG Director, and I'll be presenting this webinar together with Stephanie Curtin, who is JLL's Senior Sustainability Consultant. So without further ado, starting off with the webinar, I'd like to just give a brief overview of EPRA Sustainability Best Practice Recommendations. These guidelines were launched in 2011 when EPRA pioneered sustainability reporting in the listed real estate sector by encouraging companies to disclose sustainability information voluntarily, enhancing transparency and comparability across the market. The EPRA sBPR are sector-specific best practices that offer a uniform framework of reporting key sustainability information for listed real estate companies. The objectives of the EPRA sBPR are to enhance transparency and uniformity of reporting disclosures across the listed real estate landscape. The end result is it fosters responsible reporting, ensuring that all stakeholders have equal access to consistent and comparable ESG data. On the next slide, I would like to just briefly give an overview of the timeline in relation to the evolution of the EPRA sBPR guidelines. So in 2011, the first edition of the EPRA sBPR guidelines were launched. These only contained environmental impact indicators, and this guideline was loosely based on the GRI G3 standard. In 2014, the guidelines went through its first update, resulting in the second version, which involved updating the guidelines based on the latest GRI G4 standard at that time. In 2017, the guidelines went through a major overhaul with the addition of social and corporate governance impact indicators, also aligning with the latest GRI standards as of 2017. But more importantly, the guidelines were also aligned with the EU Non-Financial Reporting Directive. The last update was in 2024, when the fourth edition was published, in which the major change was aligning EPRA KPIs to the sector-agnostic ESRS standards, along with the usual update with the latest GRI framework as well. Coming on to the topic of discussion today, the launch of the ESRS report. The objectives of the report are threefold. So we wanted to understand how listed real estate companies are engaging with the sector-agnostic ESRS, so which data points were most commonly reported by listed real estate companies. We also wanted to find out how this aligned with the EPRA sBPR. Another objective was to provide a common baseline for ESRS reporting. So for companies who were interested in voluntarily reporting ESRS, they could identify and see what KPIs the best-in-class companies are reporting under. And lastly, we also did this report in order to identify reporting gaps and opportunities for better alignment and comparability. On the next slide, I just wanted to present briefly a timeline of the major reporting frameworks that have come into play since the 1990s. So as you can see on screen, GRI was first on the field in 1997, followed by Greenhouse Gas Protocol, then Carbon Disclosure Project in the early 2000s, followed by the UN Principles of Responsible Investing. In 2011, SASB came into being, and 2015, we saw the introduction of SBTI, TCFD, and the EU NFRD. From there on, we see the EU legislative machine pick up, and in 2019, we saw the EU SFDR introduced for the first time. In 2020, the EU taxonomy, and then in 2023, ISSB's IFRS S1 and S2 framework. Lastly, on this timeline, in 2024, the CSRD came into play. However, in 2025, the European Commission published the Omnibus simplification package, which we will explain a little bit more during the presentation, which now has put at least the EU legislative space into a bit of flux. The EPRA sBPR has always been a market-driven framework. It's designed by the market for the market and will continue to evolve to serve the best interests of the listed real estate sector. Moving on, I would now like to hand over the floor to Stephanie to go into the bit of deep dive on the report in relation to the scope and methodology. Stephanie, the floor is yours.
Thanks, Hassan. Thanks to you and EPRA for having me today. I am so honored to be here to speak about our latest collaborative report. As Hassan has mentioned, and as quite a few of you probably already know on the call, the reporting landscape is evolving. It's extremely challenging, especially because of kind of how quickly everything is changing under our feet. As Hassan had mentioned, there's been a lot of progress made in terms of the CSRD and ESRS. In terms of our report specifically, it does cover the ESRS as it stands pre-Omnibus package in February. But since then, there has been quite a few updates already taking place. After the Omnibus package, there was the progress report published in June, which really focused on specifying that there'll be a great reduction in data points and overall improvement in clarity of the ESRS. We do make reference to the progress report in our publication, in our paper. But again, as the analysis stands, it is as per the ESRS, sorry, as per the ESRS pre-Omnibus. There are, again, additional updates that have just been made within the past couple of weeks. There's been the drafts of the unapproved ESRS that have been published, as well as a quick fix delegation act. So these two, and specifically, I'll mention kind of throughout our presentation as well. But we can move on to our scope and methodology. I will first just kick off and say that our report and overall analysis did not encompass qualitative disclosures. So we didn't have a deep dive into how companies are reporting and going about their double materiality assessments, writing different governance narratives, or kind of looking forward to those kind of climate targets. So our analysis is strictly based off of the quantitative metric data points throughout the ESRS. We had 15 great EPRA members that were part of the assessment. So these companies have been EPRA members as per March of this year. They're located across Europe and the UK, and again, qualify for the CSRD Wave 1 criteria pre-Omnibus, which means that they had a turnover exceeding 50 million euros per year, a balance sheet of 25 million euros per year, and or more than 250 employees. Again, these thresholds have changed, but this was the scope of our report and assessment pre-Omnibus. These 15 companies made up 10% of the total current EPRA members. I'll give you a bit of a deep dive into our methodology next. If you want to flip, perfect. So we kind of took this in 3 different approaches, and I'll go into each one in a bit more detail on the following slides. You can hop to the next one. Perfect. So first we completed a high-level analysis of sector-agnostic ESRS disclosure requirements. This approach aimed to determine the extent to which listed real estate companies are currently reporting the sector-agnostic disclosure requirements and their associated data points. And we did this in kind of two phases. So we assessed companies on a yes/no basis to determine whether ESRS topical standards were determined material, or whether or not specific data points were disclosed under each disclosure requirement. The second phase of this essentially looked at the frequency of those topical standards and data points disclosed, which helped us reveal trends in the overall reporting behavior across the sector. Now these two phases, phase one, identification and coding, and phase two, the frequency analysis, these two phases have been applied across each of our three methodology approaches, just to create some complementary and symmetrical methods to our data collection. So we can go on to our second approach. And this was more of a specified look into quantitative ESRS data points that have been well established and consistently promoted through the EPRA sBPR since its original publication in 2011, as Hassan had mentioned earlier. This approach really aimed to closely examine those specific data points from the ESRS being reported by the 15 companies in scope, which have been compared to familiar performance measures of the EPRA sBPR to kind of assess that consistency and continuity in practice. This really allowed us to expand our understanding of the disclosure behavior while being able to identify areas of established practice versus maybe some areas which are a bit more emerging or underreported. So we could see in this table here, these are the specific performance measures that we were kind of looking at in terms of the sBPR. So a lot of utility-based consumption reporting, as well as GHG emissions and water. So we linked that to specific ESRS data points, linked to topical standards, E1 climate change, and E3 water and marine resources. So there were quite a few data points that we specifically pulled out to make sure they were included for this analysis, to make sure we can kind of see that alignment between, again, sector-agnostic ESRS and sector-specific guidelines as per sBPR. Approach 3, please, Hassan. Brilliant. So this last piece was a bit of a unique one. We wanted to develop some working hypotheses to explore how the sector-agnostic ESRS is developing and addressing known reporting gaps historically observed in the sector. How have these been historically observed? Well, every year, EPRA publishes their annual sBPR report survey, which is based off of the assessment of over 100 different listed real estate companies across Europe and how well they report in terms of the sBPR guidelines. So how well they're reporting their non-financial information. And over the last 5 years, we've been able to identify reporting gaps and trends from these surveys. And based off of these trends, we've identified hypotheses, which we then paired with specific sector-agnostic ESRS data points that reflect the disclosure areas of some of these reporting gaps. So hypothesis 1 that we developed, listed real estate companies fail to report on waste disposal or diversion routes. This is based off of the overall frequency that waste is definitely an improvement area for companies across the real estate sector. Again, this is identified by the low uptake of these performance measures as per the sBPR. And then we then linked this specifically to data points related to the topical standard of E5 circular economy and the resource outflows disclosure requirement. So making sure to pull out some of those metrics linked to those waste figures. Our second hypothesis, listed real estate companies proactively report the gender balance of their own employees, but lack the disclosure of the ratio of compensation between men and women. So overall, what we see from the sBPR surveys, diversity employee trends tend to be quite frequently reported, but diversity pay, or reporting the pay ratio between men and women, tends to be on the lower end of the spectrum. So we then linked this to the topical standard of ESRS S1 own workforce and looked specifically at data points related to characteristics of employees and compensation indicators. And then our third hypothesis developed was few listed real estate companies are implementing actions to engage within the communities which they operate. Historically, EPRA members and listed real estate companies fail to report on this topic altogether, making it historically one of the lowest scoring performance measures each year in that sBPR annual survey. So we definitely wanted to make sure we had a look at that in this assessment. So again, linked that to the topical standard of S3 affected communities, specifically looking at data points linked to kind of taking action on material impacts. So the point of this was to mostly take an analytical approach and lens and evaluating whether or not the sector-agnostic ESRS effectively supplements and supports kind of these continued reporting gaps, or if it does the opposite and contributes to a more robust and comprehensive sustainability reporting framework. So we will take a look at the results shortly of that. Speaking of results, we will kick off with the materiality trends. This is the bread and butter. I hope you're all locked in. So overall, our materiality trends did not shock us. I would be interested to see if they shocked anybody else who've joined us today. But the most frequently deemed material topics were E1 climate change, G1 business conduct, and S1 own workforce, which very nicely reflects the longstanding sector familiarity with these areas and overlaps quite well with the key themes promoted in the EPRA sBPR. On the contrary, on the right side of the graph in our little orange box, we have standards such as S3 affected communities, E2 pollution, and E4 biodiversity and ecosystems. So these were least identified as material, which and these kind of standards are traditionally considered less relevant in terms of operational terms. So again, it wasn't really too much of a shock to see this was on the lower end of the materiality side. So this is going to be the first time I kind of jump into the latest updates as per the ESRS draft and our delegated act. So if we flip to the next slide, we can kind of see some implications that this could have on our topical trends and materiality analysis. So within the new ESRS draft, there has been quite an effort to simplify and provide clarity on the double materiality assessment processes. This could impact how people and how companies complete their assessment moving forward. But again, as we've seen from our trends, you know, companies are kind of sticking to that initial DMA process as per the initial ESRS pre-Omnibus. So in the next 5 years' time, when double materiality assessments are kind of due for renewal, or during that kind of annual sense check process, these might change slightly. But again, as mentioned in the previous slide, these materiality trends are not new news to us. They're not very shocking, and they align quite well with what we've seen historically. So we don't anticipate these materiality trends to sway too much just because of, again, the historic nature of how these topics have been reported in the past. On the other side, with the quick fix ESRS delegated act, this actually allows the omission of quite a few topical standards if they're deemed material for companies in total. I will caveat that these omissions do change based off of how many employees a company has, and each topic has different omission kind of timeframes, which I won't dive into all the details on, but if you wanted extra information later, I'm sure we can send some links across for that. But essentially, we found it really interesting that quite a lot of these omittable topical standards align quite well with those topics that are least commonly reported and are deemed material in the real estate sector. So we don't anticipate this to change too much. Okay, we can move on to our sector agnostic reporting trends. So keep in mind, as per our materiality trends, it was climate change, our own workforce, and business conduct that were our most reported material topics. And this aligns quite well with what we were seeing across the sector agnostic key data points. So there were 13 sector agnostic data points that were reported by at least 2/3 or 11 or more of our 15 companies assessed. These data points and metrics spanned across topics including GHG emissions across all scopes, so specifically scope 3 emissions and market-based calculations, as well as the transparent reporting of nuclear sources in terms of kind of total energy consumption. And then in terms of own workforce, we definitely were seeing a great uptake in increased information on employee demographics, like contract type, gender across different countries where the companies reside, and additional diversity indicators like age, as well as any incidents or complaints in terms of human rights impacts. These, again, are all linked specifically to the sector agnostic ESRS and are not inclusive in the EPRA sBPR. So these are bespoke to the ESRS. They don't stray very far from the sBPR, which is very interesting to point out, and we'll talk about that a little bit more later. But I think in terms of, overall trends and most reported data points, these are just an extension of kind of what we're already seeing in the real estate market. So it's great to know that the sector agnostic ESRS is adding kind of that additional layer of disclosure and robust reporting. On the next slide, we'll kind of see how this might be impacted by some of the latest updates. So overall, the ESRS drafts are kind of superseding the progress report published in June, which mentioned that they were going to reduce data points by 50%. Actually turns out that the draft is proposing 66% of data points to be reduced. So it will be quite interesting to see which are those have been omitted from the overall ESRS. And then overall, 50% of mandatory data points will be removed as well. So having a massive impact on kind of that reporting expectation from companies moving forward, which could definitely impact some of these key data points currently being most commonly reported. In terms of the Quick Fix Act, Again, more specifically to these areas, it could allow the emission of scope 3 emissions for those companies who have up to 750 employees, and could potentially allow the emission of own workforce metrics, again, dependent on company size. Those metric emissions kind of look a little bit different. But overall, I would say scope 3 specifically, we wouldn't anticipate to drop too much. If it's already most commonly reported data point, we don't imagine companies will roll back on that disclosure. It will, although, allow companies who haven't yet reported to the ESRS a little bit more time to compile that data and that value chain kind of scope 3 emission information before disclosure. So those already reporting it, we don't imagine will roll back on that reporting, but those who are still preparing for their first ESRS submission, they have a bit more time to prepare that data. But scope 3 is one of those, again, although it's not required or seen as a core recommendation as part of the EPRA sBPR, it is being reinforced by initiatives like ARESI, which is the Aligning Real Estate Sustainability Indicators, which really shows the kind of combination and convergence between voluntary efforts and formal standards. So as we see the ESRS simplify these disclosures as, scope 3 emissions are expected to remain central, again, especially as more sector-specific guidelines and standards are promoting this. I think that wraps that one up. We can move on to our alignment to the sBPR. Beautiful. So overall, I think a big takeaway from this report as a whole is that the EPRA sBPR remains a critical point of reference for sustainability reporting across the sector. We can see that in how many of the data points we reviewed are directly comparable to the sBPR performance measures. So out of the 162 ESRS data points assessed, 41 of those are directly comparable to performance measures, which really shows the overlap between the two, the standards and the sBPR guidelines, and kind of how forward-thinking the sBPR has been historically, and will continue to remain kind of as that consistent guideline for companies moving forward. But this little pie chart here, it indicates those 41 specific data points comparable to the sBPR. Out of those 41 data points, 26 of them were reported by 2/3 of the companies assessed, or at least 11 out of the 15 companies included in the assessment. So again, it creates a really, really strong baseline reporting methodology and guideline for listed real estate companies to establish their sustainability aligned reporting. We'll dive deeper into some of these data points on the next slide if you want to move on, Hassan. Beautiful. So out of some of these 26 data points, they're made up over very familiar topical standards, again, E1 climate change, own workforce, and business conduct, again, which we saw as our top contenders for our materiality assessment. So within climate change, again, the data points most linked to the EPRA sBPR performance measures included energy consumption reporting. So these are things like your electricity, your fuel, district heating and cooling, as well as the breakdown of renewables and non-renewable sources in each utility, as well as scope 1 and scope 2 reporting on a location-based metric, as well as GHG intensity. So all of those are consistent across the sector-agnostic ESRS and the EPRA sBPR. Moving into own workforce, there's quite a lot of overlap here as well. Looking at the companies, the amount of companies reporting total headcount and turnover, disclosing health and safety indicators like injury rate, lost day rate, absentee rate, and et cetera, as well as compensation indicators like gender pay, and the gender balance of the governance board, which is linked to ESRS 2 Gov 1. So this kind of looks at the greater disclosure of the makeup of the governance board. So this specifically linked to the sBPR is kind of the gender balance of the board, as well as how many board members have sustainability expertise. And last but not least, business conduct, conflict of interest for sure is highly reported across the board and links very well with the historic performance measure of government conflict of interest. So a lot of overlap between the two, again, which really just sends the message that the EPRA sBPR is a crucial guideline for kind of everyone in the real estate sector, still providing that sector-specific guidance where there's historically been a gap, but again, is very well linked to the latest ESRS standards as pre-Omnibus. So it'll be interesting to see how the ESRS plays out in the final 2.0 version, and whether those kind of overlaps and comparisons still lie. But in a bit more detail on that, we could hop to the next slide. So linked to some of these data points specifically, again, we mentioned that GHG emission intensity is extremely well reported, as it is well promoted in the sBPR. The draft ESRS actually changes kind of the wording and the expectation of this requirement. Before, it was requiring emission intensity to be on net revenue basis. It's now not only limited to net revenue, but can be applied to other kind of business metrics. So in the case of listed real estate, we might see the continuation of intensity being calculated on a meter square footage basis, in line kind of with what we see promoted in the sBPR. In terms of the Quick Fix Act, again, some of these own workforce data points could be omitted for the next couple of years for some companies up to 750 employees. For those with more than 750 employees, this only allows the omission of health and safety indicators as per these kind of most reported data points. So we might see some change here. Again, I think those who are already reporting these data points, it's unlikely for them to roll back on it. But again, just gives those companies who are still preparing their disclosure a bit more time to gather this data across their business. Okay, last but not least, we'll talk about our hypothesis results. So we could hop on to the next slide. Beautiful. So I'll run through each of these and kind of share how we felt the hypotheses were either supported or not. So hypothesis 1, again, listed real estate companies fail to report on waste disposal or diversion routes. Again, this comes from the historic lack of reporting of waste data and or need of improvement across EPRA members. But actually, our hypothesis was not supported, as we actually saw companies determine the topical standard E5 circular economy to be material, which then waterfalled into them having to disclose quantitative data points on total waste generated and the disposal breakdowns of their waste. So yeah, we saw more than 50% of the companies that we assessed include waste data, which kind of shows the uptick in this reporting. Previously kind of gapped reporting metric, an improvement in that, which is really positive. Hypothesis number 2, listed real estate companies proactively report the gender balance of their own employees, but lack the disclosure of the ratio of compensation between men and women. Overall, again, our hypothesis was not supported as it was really well reported by the companies we assessed. 14 out of the 15 companies were disclosing workforce compensation data in terms of gender pay and gender breakdowns as well. So again, we saw kind of an increase in reporting in terms of gender pay, disproving the historic trends we found in the sBPR surveys. And third, few listed real estate companies are implementing actions to engage with the communities in which they operate. This was the only hypothesis that was supported, as we only found 4 out of the 15 companies assessed list affected communities as material. And then in some data point cases, we had even less than 4 of those companies report actions taken against their affected communities to reduce risk. So this was supported because it well aligns with the lack of reporting in terms of community engagement as per the sBPR surveys. But overall, I think these hypotheses results supports the broader findings of the overall report. While sector-agnostic ESRS has driven a more structured and consistent reporting reporting on environmental and workforce indicators, it's clear that materiality still remains a key component for disclosure coverage. So again, the only reason these companies would be reporting data points related to these hypotheses would be because the topic was determined as material for the business. So that materiality assessment remains a key component for sure. The overall findings here indicate that the sector-agnostic ESRS is influencing reporting behavior, particularly in the historically underreported areas, as I mentioned, of waste and gender pay. But this shift really demonstrates the growing impact of the requirements, provide an extra layer of depth and consistency. Again, at the same time, we're seeing consistent gaps, specifically in that community engagement area. So it'll be interesting to see how that plays out. But again, I think community engagement tends to be, from what we've seen in historic reporting, tends to be an operation more of investor tenants. So actually kind of isn't a material topic for many of the listed real estate companies, which is most likely why we're seeing the continuation of this gap. On the next slide, we'll see if any of these are impacted by the latest updates. And we do, again, I know this omission of own workforce companies continues to get brought up. So again, for those companies with up to 750 employees, they're allowed to omit any of the data points or disclosure requirements that fall under own workforce if it's deemed material to them. Again, those timelines of omission are dependent in different areas and different topical standards, as well as affected communities. Again, I think we've hit the nail on the head with affected communities. It's not well reported. It's often determined as unmaterial for a lot of our listed real estate companies. We don't anticipate that to change too much. But again, in the case where it could be material for some companies, as they're reporting and preparing to report to the ESRS, they have some time to omit that data while they compile that information across the business. Okay, that is our results for hypothesis. I will just give a quick recap over our conclusion, draw some final key messages, and then we'll open it up for Q&A. So overall, I hope this has been insightful for most of you on the call. I think the main messages to really drive here is that the overall analysis really confirms that those listed real estate companies already addressing core ESRS data points, particularly in the areas of climate change, own workforce, and business conduct. They're very well reported, as well as are on top of the materiality assessment list, and really well reflect those long-standing recommendations within the sBPR. So again, we saw those most commonly reported data points across sector-agnostic and sector-specific sBPR, mostly all related to those 3 topical standards. So again, I think if you're kind of looking for best practice in terms of what the sector is doing today in terms of sustainability reporting, these are kind of the 3 areas to focus on. Secondly, we are seeing quantitative disclosures generally well developed and reported, especially in areas such as energy use and consumption, GHG emissions, and employee diversity. Again, there's very clear alignment with the sBPR and quite a few of those performance measures. So again, really driving that message that the sBPR is here to stay, and it's a great kind of baseline for sector-specific advice and guidance. And then last but not least, as Hassan has mentioned, as it's been kind of reiterated through this presentation, ESRS is ever evolving, the reporting landscape is ever evolving. Very much looking forward to the ESRS 2.0 publication by the end of November, and hopefully there'll be a little bit more consistency in reporting across the board, although I think that might be a little too optimistic. But essentially, with all of this change and evolution, listed real estate companies will need to operate and are suggested to operate with a dual framework, meaning that continue to use the EU regulatory frameworks. But as that environment, again, continues to change over the political landscape, you know, that expectation of consistency is low, I think. So you need a dual framework to kind of create that consistency for you. So you'll look to sector-specific guidelines like the EPRA sBPR to really help guide you through your reporting and your non-financial disclosures. So again, I think it's really important to kind of create that dual framework for yourself. Find those sector-specific guidelines that work for you, that are in best practice, that your peers are using, and use that alongside of your regulatory requirements that you're complied to disclose against. I think that's pretty much it, Hassan. Something to mention as well, hopefully, again, great, there's a QR code. Please access the report, please give it a read. Again, there's some mention to the progress report, but not necessarily some of the latest updates as per the ESRS draft and the Quick Fix Act. But there are updates as per the progress report in the QR code, as well as an appendix at the back of the report, which again, for those of you who might be just preparing your ESRS disclosure, want a little bit more guidance in terms of best practice, the appendix should act as a bit of a sector-specific baseline on how you can prepare your ESRS disclosure. So it would include all of those kind of most commonly reported data points, and specifically links those to the EPRA sBPR performance measures where that comparison is made. So definitely have a look at the report, use that appendix as your friend. But yeah, hopefully this was really insightful. And we've got 14 minutes for questions. So very happy to invite Hassan back to the floor and we can address those. Thanks all.
Just Stephanie, I think there's a lot of insight that's been shared. I think that will continue once the audience starts accessing the report and start reading it. So hopefully all the time we spent on drafting this report is of value to the market. So we've got quite a few questions coming in. So probably we'll just pick up a few. So I'll pick up the ones, actually there are two which are related to the EPRA sBPRs. So without taking names, just mentioning one question is, what's EPRA's position to these changes? Is EPRA going to update the sBPR guidelines? Well, that is always a topic of discussion. EPRA sBPR is market-led, and I try to specify that point because it's the listed real estate company sitting with the users of the ESG data, which is both buy side, sell side, and deciding, okay, what do we do and how do we promote better transparency, better comparability in the market. So everything's on the table in that end. And with the flux that we see, at least in the European Union side, we expect that discussion to happen later this year. So yeah, I think that again would be based on what the stakeholders decide, whether we update, how do we update, who do we align further with. For example, International Sustainability Standards Board, IFRS S1, S2, whether that becomes more relevant, should EPRA align with that? So everything's on the table. So not exact, I don't have an exact response, but it will be discussed. So I think that was one question. I think there was a related one again. You mentioned that 41 data points are directly comparable to ESRS data points. Do you foresee sBPR data points to be extended? Sector, again, I think this connects to my earlier point. So this will be a discussion between the EPRA stakeholders, again, EPRA members deciding on how to approach this evolving landscape. But also, I think on the very short term, how Stephanie mentioned, probably my thoughts would be more on a dual framework basis. So what is legislatively out there, even though it might not apply to your company. I think the whole idea of the report is that companies can take guidance on what best in class are reporting under, and then of course supplemented with the EPRA sBPR framework, which has more than 14-year track record of being reported very well. So hopefully that answers your response. And then Stephanie, leave it to you if you want to pick up some of the questions.
Sure, let's see. To what extent, if all, do you think this simplification will lead to gaps in data coverage or underreporting of emissions or overall reduced transparency in the market? I think it's interesting. I think, again, it depends on how the new threshold of those companies kind of captured under CSRD, kind of how it impacts the amount of those companies. I think overall, as we see from our annual sBPR assessments, companies in listed real estate are only getting better with their sustainability reporting and more transparent in terms of non-financial information. So although we might be seeing legislative simplification, there's been already a lot of companies that have done quite a lot of back-breaking preparation for ESRS. So it would be unlikely for them to roll back on all of that effort that they've gone into creating better data management platforms or upskilling their internal employees to prepare themselves for CSRD and ESRS and getting all of their stakeholders internally involved. So although there will be a great simplification of the data points, I think because there's been quite a lot of companies in the market so heavily involved in the preparation, all that time and effort and money spent already to prepare, they won't not disclose in that situation. And again, as we mentioned, kind of having that dual framework, we're expecting quite a lot of the data points that will stay within the ESRS will still be linked to sector-specific guidelines like the sBPR. So overall, in terms of the real estate sector and investor uptake and interest, it would actually be in the interest of the companies to continue to report. It'll be interesting to see how that turns out, but that's kind of our guesstimate, if that makes sense. And the next one with the ESRS simplification, reducing inventory data points, how should real estate companies decide which are low priority topics? Yeah, as I kind of mentioned throughout the report, materiality is key and the DMA is not going away. Again, kind of on the back end of my previous explanation of so many companies have put in so much time and effort into preparing for ESRS, including double materiality assessments. This has been new for quite a lot of companies, and it's also linked to the ISSB IFRS S2 that looks specifically at financial materiality. So it's actually in companies' best interest to kind of complete a double materiality assessment to kind of comply with multiple frameworks now. But again, it's a good point, but because of the heavy drive for DMAs, it will be the double materiality assessment that determines what topics are low priority for each individual company. So I think that's difficult to say across the sector. Again, we had some great trends from our report in terms of maybe what we can expect in terms of low reporting, low priority topics. But again, it will be mostly determined by each individual company's materiality assessment.
Thank you, Stephanie. I think just to close off, if anyone would have had a conversation with me in January this year, I would have said, look, my forecast for the next 4 to 5 years is that market-led initiatives will start losing prominence as more and more the regulation comes better entrenched within the EU and the UK. Come February, everything has changed. So how we see it, which I personally see it as a political move, we would see the market-led initiatives getting more and more traction going forward, because as Stephanie, you very well identified throughout the presentation, we do foresee dilution, especially on the CSRD side, effectively. And I think the market needs credible, transparent, comparable data. So I think that will continue going forward. So yeah, that will keep us busy. So hopefully that adds value to our members, and please feel free to get in touch with us or JLL in case you would like some further clarity, have some further questions. And from my side, thank you for joining. It's been great presenting to you all.
Thanks all. Thanks for having me.
Thank you, Stephanie. Bye-bye.